What's up, everybody? It's your boy Trey back again for another video. Today is a pretty cool day. We have an opportunity to look at something from a cool handle. His name is Dave Hebert _, who tweeted out something quite magnificent, and I wanted to be able to take the time to talk about it.
Guys, check this out. I thought this was a pretty cool learning opportunity. Are you tired? Are you tired of the sell-off that we've had? Which by the way, something pretty interesting happened at the close yesterday that and I'm quite satisfied with, or more specifically the open that I'm quite satisfied with. We'll talk about that later. But this I think played a partial role, and I wanted to be able to take the time to talk about it. We're gonna keep this nice and short. Amount of financial advice, not financial advice. Please take it with a grain of salt. What you see here is Unusual Whales. This is a platform that sort of tells you live options flow as it's rolling through. And if you have no interest in this, that's all right. You can click off, whatever. But I actually want to take the time to talk about this because this is an interesting short-term bet. I personally would not have gone that deep out of the the money on this because as I'll explain to you in a little bit, you might have to pay a little more than is presently trading for the time being. That's all right. Let's kind of talk about what this is. So what you see here is a sold put. There's a whole bunch of, you can see the side right here is sell. Typically this will say either buy or sell. You see calls starting to roll in. You see sell orders right here on puts. I find this to actually be a lot more indicative of what could come in the future for the stock right now than any massive amount of bullish flow that's coming in. And I want to tell you why. What I mentioned in yesterday's video was an imbalance on the options chain, right? You look at the money calls right now. These are currently trading for 56 cents. You look at the puts at the money, and these are trading at about 54 cents. So they're slightly more expensive. There's a much larger gap yesterday, and this is sort of starting to change once again here today as we're looking at sort of what's rolling in on the stock, right? This balance, and what you're kind of starting to see with the balance in terms of premium cost for each of these designated, call and put situations fluctuates because of demand. And this right here is a shift to the put side becoming more expensive. Why is that? A sold put is actually bullish. Now, I know the word put is a bad word, but I'm actually happy about this because this is the opportunity where I can talk to you guys about this and say you can actually be excited about this, whether you agree or disagree with my theory or you don't agree with my theory or whatever, right? Check this out. Selling puts is bullish, and I want to explain to you why. So if you were to think about the opposite sides of trades, right? You've got long puts and you've got short puts, or essentially selling puts, right? A long put is the right, but not the obligation, to sell 100 shares of stock at any designated strike price. So if I had a long put and I decided to exercise this, and let's just say that it was at $18, and we happen to close tomorrow at $16. We close on Thursday of the market this week, right? I would have the right, but not the obligation, to sell 100 shares at 18 instead of at the closing price of 16. But at the opposite side of every single trade is the person who sold the contract, right? This would be considered a short put. Most of the time, the market makers are the ones who are selling these puts or calls or whatever, but people do play this. And there's sort of two different ways that you can play a short put, which is cash secured and naked. Both of these being bullish, naked puts having inherently far greater risk. And we'll get into that sort of as we go on. It's not quite the same as a naked short. It can really fuck you over if you're not careful. But I found this to be of interest. So check this out. A short put is an obligation to do something if it happens, right? It's an obligation, not a right, because what you're doing is selling to this guy who has the right, but not the obligation, right? So on the opposite side of this trade, if let's just say that we were to sell puts, and we look currently at what is happening with sort of the chart and the flow that came in, you can see a whole bunch of freaking 25 puts that got sold, ranging in different premium. $30,000 here, 86,000, 125, 215, 26, 31, 86. You can see how drastically this is. I mean, this is a lot of money. A lot of money rolled in on these sold $25 puts, which is inherently bullish. What does this actually mean? So if what we have here is sold $25 puts, the opposite side of that means that somebody went long on $25 puts, whether it was a market maker or as retail or as an institution. Somebody on the opposite side of this is now long on a $25 put. which means this is currently in the money. What does that mean for the long position? It would mean that they have the right, but not the obligation, to sell stock at $25, right? Well, if they're selling it, who do they sell it to? The opposite side of the trade, a short put, right? These guys selling a $25 put means that they have the obligation as of right now to do the exact opposite thing, to buy 100 shares at a designated strike price if the long side of the trade ends up expiring in the money and they decide to exercise. So what would this mean? They have to buy a 100 shares at $25 instead of whatever it is trading at, especially if it's above, right? This is actually a way that you can buy stuff for cheaper if you think in the very short term a stock is going to go up significantly. That's a thing that can happen, right? So you are the opposite side of this. If you're long put, you have to sell 100 shares, the right, not the obligation, to sell 100 shares if it expires in the money at your designated strike price. In this situation, if it is in the money and this guy exercises, you have the obligation, not the right, to buy that 100 shares for him at that strike price to sell, right? Or you're more so, you're buying it from the guy who's selling it. Makes sense so far. With that being said, there's sort of two ways you can play this. Cash secured puts, which is essentially collateral. Your broker, if they don't suck, if they're not a piece of shit, will basically say, hey, we need cash secured here as collateral if and when this ends up coming to fruition and you are obligated to fulfill this transaction. So a cash secured put in this situation would mean that for these $25 puts that were sold, they will set aside all the money that would be necessary to buy 100 shares at $25. So what you got to do really quick here is 100 times 25. You just add the zeros to this and you get kind of get what you got to look at. That's how much cash you have to set aside. A naked put, you do not have to put up cash collateral. They would just expect that, hey, if you are obligated to buy this stock, we will need you to deposit money. You're going to get a margin call. Naked puts, I think, are typically pretty risky. We're not going to dive into that. I want to be able to discuss two sort of takeaways from this, as I kind of find important. Selling these $25 puts, what was sort of the benefit of this? Well, inherently, one thing that it does is it makes puts more expensive. It would make calls, the call and put sort of demand equal. It's inherently a good thing. It's going to force market makers to look at this put and say, I'd kind of enjoy collecting this premium right here if it's at all possible, which is what this guy would be doing if he didn't sell a $25 put. He really must feel confident in the fact that this is likely going to go over $25 by tomorrow. I think that's a pretty risky bet. This is more of a YOLO to me. If you're comfortable buying these $25 puts, then so be it. You do what you got to do at the end of the day. That just kind of is what it is. This is one of those scenarios where if you don't want to buy the stock for more, what you would look to do is buy it deeper in the money, right? You'd be looking for maybe like a 10 or a 12 or a $9 sold put, because then if it runs and you're obligated to buy, you're buying it for a lot cheaper, right? That's sort of the risk at hand here, right? Rather than collecting premium. So that's inherently a good thing, right? It's going to balance sort of the demand between these two things so they're closer in value. The other thing is that this typically means somebody in the very short term is making a bet that the stock is going to go up violently compared to where it is right now, which is not quite there yet, right? The stock is trading at $17.96. But there is sort of a good sign that I did not discuss yesterday. I'd like to. This falling wedge, check this out. Broke out of the falling wedge. What did it do after that? Bounced right off of the tip of this falling support line, which was previously resistance. And that bounce off of that support line and the follow through is what I'm the most happy about, right? That follow through going into today is inherently a bullish thing. And I'm pretty happy to see that. And I wanted to be able to discuss that as I see that it's kind of matched up with sold puts. Sold puts typically meaning bullish things. You can kind of get jack nipples here. So grand takeaway, we'll make another video here later today. But the grand takeaway for me is this put situation, no matter how you look at it, no matter what you do, no matter what you say, is inherently bullish. And I kind of thought that was a good thing. It's not bad. It's not a bad thing to see. And I've got some more stuff to talk about here later today. So I want to be able to chat about that. I thought this was a pretty cool thing to see. And I suppose that's what I got. So I'll be back later. Appreciate y'all. Catch y'all later. Much love. Light taps. Peace.